Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we are diving into Apollo Global Management's recent report. Get ready, because this one has a few surprises, or maybe not so surprising if you've been following the markets closely. We will check into their earnings and what it all really means. This is Apollo Global Management's current report, filed in early May of 2025. These reports give us a snapshot of what's happening inside the company, straight from the source. This isn't just any report, it's a Form 8K. Think of this as an oh snap report. Companies file these when big unplanned events happen that investors should know about ASAP. So something important definitely happened. The main point of the report is to summarize Apollo's financial results for the first 3 months of 2025. So let's check if Apollo had a good or bad first quarter. Apollo released a summary along with a more detailed presentation on their earnings. We'll check both, but keep an eye out if the summary matches the details. First, let's check the types of stocks they offer. They have common stock, of course, but also something called mandatory convertible preferred stock and fixed rate junior subordinated notes. These are fancy ways of raising money, but can get really complicated. Now let's look at the numbers. Here's where things get interesting. We can see a good picture of where the company is at this moment. Let's see if the income statement can show some interesting information regarding revenue. Apollo makes money through fees from the assets it manages. Think of it like this. They are money managers and they charge fees for handling other people's money. Fee revenue is a significant part of their business. Fund management fees are up from last year at this time. It appears they increased from roughly $779 million to $875 million. They are managing to maintain positive growth. The presentation also shows other revenue, which is a big change. Last year they had $130 million, but this year is a negative $245 million. That's more than a $350 million difference. It would be important to dive deep and understand what other encompasses and what triggered that negative change. Expenses is always the other side of the coin. It's important to see if revenue is increasing and expenses are not, or vice versa. Compensation and benefits is a big piece of Apollo's expenses. It went from about $450 million to $560 million, which is more than a $100 million increase. That's quite the jump. Raises and bonuses can be a good thing if the company is doing great, but can be a problem if not. General, administrative, and other expenses went from about $170 million. Expense growth is never a good sign, and it's important to understand what happened there. Taxes are unfortunately a part of business. Apollo paid almost $60 million in taxes, which is down from about $80 million last year. Here is the number we want to see. Net income shows the profit. Apollo's net income available to common stockholders is about $260 million, down from roughly $400 million last year. That shows the company's profit is decreasing. Is that a trend? We should keep watching. Now, let's switch to assets under management, or AUM. This is the total value of all the investments Apollo manages for its clients. AUM is a key metric for any investment firm as it directly impacts the fees they can generate. Most of Apollo's assets under management are in credit investments. This includes loans, bonds, and other debt instruments. It's like they're the bank for other businesses. Private equity is where Apollo buys entire companies or parts of companies with the goal of improving them and selling them later for a profit. This is a smaller part of their AUM. Real assets are physical assets like real estate and infrastructure projects. It's only a small piece of their AUM. Insurance solutions is where Apollo partners with insurance companies to manage their investments. This is one of the fastest growing areas for Apollo. Equity is another category, and it's important to see what kind of equity investments Apollo is making. Let's talk about IRR, or internal rate of return. This is a way to measure the profitability of an investment over time. It's a percentage that tells you how much money the investment is making each year. On average, private equity is at 24% IRR. It means their investments in this space are performing quite well. Real assets are not doing badly at 14%, good performance. Credit is still a solid 13%. These results will attract investors to invest with them. Insurance solutions are also good at 11%. This shows how they can deliver to investors. It's important to compare gross IRR to net IRR. Gross doesn't include fees, net does, so fees from Apollo will decrease returns to investors, and we want to make sure those fees aren't excessive. Total return is a way to measure how well an investment has performed over a specific period, taking into account both income and capital appreciation. Now, let's zoom out and think about what this all means for Apollo. Apollo stock is publicly traded, so their financial performance directly affects their share price and investor confidence. Apollo also issues different types of stock, like preferred stock. It's good to understand how these securities affect Apollo's overall financial picture. Apollo focuses on something called economic net income. This is how they measure their true profitability, taking into account all the different parts of their business. It's important to look at this number to get a sense of how Apollo sees itself. It's important to know how ARM is trending because that's how they make money. If ARM decreases, they make less money. Apollo has most of its assets in credit, so we need to watch for changes in the credit market. Finally, the report is signed off by the Chief Financial Officer, which gives it the stamp of approval. Now, looking at these results more broadly, Apollo shows a few red flags. While their fee revenue from fund management is increasing, their net income is down. This could be a problem if the trend continues. Apollo depends mostly on credit investments, and we need to watch that closely as that is a potential risk. If those investments don't perform well, then that would affect their fee revenue. On a positive side, IRR results are positive and show the investment firm is doing well. Thanks for watching. If you enjoyed this video, please subscribe, like, and comment.